What is up, everyone? It has been quite some time since I have uploaded a YouTube video. Nonetheless, I have got a lot lined up in relation to obviously new content when it comes to types of strategies and just perfecting your trading overall. This video is going to be solely based on lower time frame and how to become more efficient in your executions and just how to understand and trade on the lower time frame more effectively. As a lower time frame, there is a lot more noise and it is quite complex and hard to grasp in comparison to the higher time frame. Reason being, a lower time frame it often contains more price fluctuations and noise, and obviously it can lead to false signals and make it harder to identify an underlying trend. However, following a few set of rules when it comes to the lower time frame, we can eliminate as much of this noise as we possibly can and help you get a clearer understanding in where the markets could potentially head. So essentially in this video we're going to be covering what I look out for when it comes to the lower time frame. We're going to be giving you some examples of it. What is the best time frame to trade on the lower time frame? Now, there isn't a best time frame. I found that the best time frames that work for me personally being the 5-minute and the 3-minute time frames. However, the lower on the time frames that we go, your accuracy it tends to decrease as there is a lot more going on the lower time frames, and you need to be quite snappy with your responses to the extreme fluctuations in price that can occur on the lower time frames. Okay, now on top of that, we need to figure out when are the best times to trade. So the best times to trade, in my opinion, will be obviously during London and New York. That's the time frames I've been trading on the lower and the higher time frame. So we're going to stick to what we know. That personally, I found on the lower time frame, it is mostly effective on the first 2 hours of the session, and obviously I tend to stay away from the crossover between London and New York. However, you can trade during those times, and obviously you can trade beyond the 2 hours that I did mention. It's just what works better for yourself. There is a few things obviously you have to take into consideration. Obviously, I'm just going to clarify all of this stuff first, and then obviously we're going to get into some live examples now. When you're on the lower time frame, we aren't really looking to hold trades for that long, seeing that obviously price can move quite a bit in the lower time frame, but we're not talking about 100, 200 pips. We're talking about 20, 30 pip movements. So obviously the trades can be as little as 5 minutes, and on the longer side a couple of hours. But we're going to be targeting on average a risk to reward between 1 to 2 and 1 to 5. Nothing stupid like a 1 to 30 as if we were doing a swing trade over a couple of days or anything of that nature. Okay. Now, when it comes to obviously figuring out on the lower time frame if we want to go long or short, there's a few things that we can take into consideration obviously when analyzing whether we should go long or short. Now, the first thing that we'll be covering is analyzing price action at the session open. Okay, so we look for price action for the open of each session to figure out whether it's mainly bullish or whether it's mainly bearish. So I'll give you an example here. We can see in comparison to the open of London session, the first hour to the close of the first hour, we can see that the close is lower than the open of the first hour. Therefore, the price action for that first hour was generally bearish. Okay, now that's an early indication into whether we're going to be looking for shorts or longs, but it isn't a conclusive answer. Essentially, it's not okay, yep, so it's bearish, that means we're going for shorts. We have to take into consideration a few other things when we do look at obviously executing the trade. Now, that's just an early indication, and obviously the same applies if we're looking for longs essentially. So in this example here, you can see that the open the close in comparison to the open is higher. Therefore, it's an early indication that price will remain bullish for the remainder of that session. Now, when we do actually look into obviously figuring out, okay, now we've got the early indication, now we have to figure out, okay, what can we look to further solidify this into whether we're going to look for shorts or we're going to look for longs. Now, when it comes to obviously furthering our confirmations and confluences in relation to obviously figuring out if we're going to go long or short, we need to look into price action after the first hour. Okay, so we're going to look for further confirmations once the first hour has concluded. Now, once the first hour has concluded, I'll just zoom into this area here. This is a gold we're looking at. This is gold we're currently looking at. We can see that price initially at the first hour here, which is obviously the red box that I'm circling with my mouse now, we can see that price did close lower than the open. Now, that's just the early indication. Now, when we want to look for the short position, we want to see price, once the first hour has concluded, to continue to present bearish price action to us. Now, we can see that price continued to make a bit of a lower low, and then we can see that it consolidated a bit. Then we had a push to the upside, and then a continuation to the downside once we had got that confirmation that price was continuing to the downside. And now the same applies if we're looking for longs. Essentially, we see that the first hour was bullish, and then we can see that there's a continuation to the upside where price continues to print higher highs and higher lows, essentially, or just bullish price action in general. Now, it's all good knowing, obviously, now that we're looking for shorts and we're looking for longs, there's a couple of other, a couple of other confluences that you do look out for. However, I won't be covering those as it is exclusive to the Discord members, and it's something that I have covered with them. So obviously, if you are interested in finding out more about this strategy and obviously bettering your understanding, the link for my Discord is in the bio below. So if you're interested, it's a one-time fee of $80, and it will obviously give you access to my fundamental course, my higher Timeframe course, and obviously the access to the Discord for a lifetime membership, essentially. And obviously I do divulge further into further confluences and different entry models. So we're just going to go into, we're going to just essentially look at one confluence and one type of entry model, but there are various entry models that are covered in the Discord. Okay, now back to obviously looking at price action once we have figured out that price is bearish or bullish, and now we're looking for longs or shorts. Once we've identified if we're going to be looking for longs or shorts, now we have to start looking for some sort of essentially we're going to be looking for some sorts of entries. So figuring out where's the best place to enter a long position from or a short position from. Now, when it comes down to obviously looking for a short position, we've seen that price has continued to the downside. So we've got that confirmation that price is heading to the downside. But what we want to look out for is obviously the typical supply and demand entry models when it is looking for, obviously that's the entry model we'll be covering in this video, but we'll be looking for the supply and demand entry models when it comes to identifying key areas to enter from. Now, this example here that I've got up in front of myself, we can see that price has created that bearish price action, and then we've looked for that retracement. So whenever we are looking to take these positions, we want to see price retrace back into that first hour range and look for an entry within the first hour range that was created during that time at the open of each session. Okay, so this is a prime example here. Price has created some lower lows. We've seen prices continue to the downside. Now we've got a retracement back into this area here. And if I just do mark it out, we can see there's an area of supply here, and price retraces back into that area. And then we can see price sell off to the downside and a continuation to the downside. And we can look for some short positions there. Okay. Now, when it comes to take profit selection, the typical take profit selections can be used: imbalances, equal highs, equal lows, areas of liquidity, so on and so forth, furthest areas of demand or supply that we could look on the higher time frame, and anything of that nature. Okay, now there's another tool that we can use to obviously look for potential areas. It is a standard deviation tool. The settings for this are in my Discord, and this is a key area. It's a standard deviation of the first hour, the complete range of the first hour of the session. Okay, so this is basically points, so 0.5, 1, 1.5, so on and so forth. They are points that are significant in the market in relation to the complete range of the first hour that was created during open. So these are key points that I tend to use when looking for take profits. So we can see that depending on how price action was during the session, we can look to take profits around areas of standard deviation. Okay, so for a short position, we want to mark out from the high to the low, and we can see 0.5 standard deviation here. It lines up with a low here essentially, and it also, we can see that price did end up hitting that area depending on the movement during the first hour. We can obviously look for more extended take profits. I tend to keep it 0.5 and 1. However, if we do have a massive impulsive move during the first hour of the session, we can look to take trades to longer take profits. Okay, so we can look for the 1 and the 1.5, and we can see in this scenario price did hit all of those take profits that I just did mention to yourselves. Okay, but I tend to stick to 0.5 to be on the safer side of things, and we can see it would have been a 1 to 3.5 regardless. Now, if I give you another example of these types of entries, we can see here in New York session, price, the open compared to the open was higher, so we're looking for some long positions as we saw price continue to the upside. We saw that break above the wick high of the first hour, and then we can see a retracement back into the range created by the first hour, and then we can see price react off of this, and we can see a continuation to the upside. Now take profit, similarly to what I said before, we're looking to mark out the high and the low of the wicks within the first hour session, and then we're looking for some standard deviation points here. So you can see that price had more, there was a lot more going on in the first hour in relation to obviously price action in this session compared to obviously the previous example I gave you, and we can see that price did line up perfectly with the one standard deviation point that I am circling with my cursor now, and that is a brilliant example essentially of looking at using the standard deviations. Now it's not just limited to the standard deviations, and there are a range of other entry models that we can look into when it comes to obviously executing trades and obviously looking for take profits, but in this video I'll only be covering these two here. If you'd like to figure out more, obviously the Discord is available to you. But we'll be going through a couple more examples. So it doesn't always work. I'll just a few disclaimers. Where if there are high impact news, if there is high impact news in that day, we'll tend to not look for taking any trades on the lower time frame, where obviously when high impact news does come into play, your strategy may not be respected. But if we do stay away from obviously the higher impact news and we do trade it on a day that doesn't really have any red folders, we'll see that price tends to stick to what we're saying. So another model that I will actually include is, this is a key example here. We got price was bearish, so the close, this is the funny one, so the close was lower than the open. However, we saw price break above the wick high on the left here, and once we've seen that, it reverses our from short to long, and then we can see price retrace back into this inefficiency here, and price then continues to the upside, and we could have looked for some long positions from this inefficiency that I am marking out here, and we could look for some long positions to the upside using the standard deviation once again to figure out exactly where we can look to implement some take profits, well, essentially get out of the trade. And we can see once again the significance of the standard deviation points. The standard one is completely the whole size of the the first hour, essentially to the upside or to the downside, depending on if you're looking for longs or shorts. And we can see that price perfectly lines up with the one standard deviation point, and then price reverses to the downside. So that's a key area that we can look out for when taking profits. And obviously we can see it lines up with this area of supply here and the previous range of Asian session. We can see that it up with the low of Asian session in the first hour perfectly, essentially. So that's just a further confluence that you have to look out for, obviously. It lining up with other ranges, and obviously where the standard deviation points are pointing to, and essentially supply and demand areas and inefficiencies or anything of that nature. So to conclude, what we want to look out for is obviously the first hour range. We want to see whether it's bullish or bearish. However, it's an early indication, not a conclusive answer, as if we're going to be looking for longs or shorts. Secondly, we want to see where price continues after the first hour has closed. If price continues to the downside when the first hour was bearish, then we'll look for a retracement back into the internal area created within the first hour, and we'll look for some entry models. Obviously, we have covered the supply and demand entry models, but we can look for further entry models, and obviously those are discussed elsewhere. We also want to look out for take profit selection. So standard deviation points, equal highs, equal lows, inefficiencies, areas of liquidity. We also want to take into consideration if there is any high impact news occurring, then we tend to stay away from trading that session, as your strategy is likely to not be respected. And also, we want to have a look at what the overall trend is as well on the higher time frame. So when it comes to the higher time frame, we don't have to essentially look at the 1 week, the 1 day, the 4 hour. If you can simply have a look on the 1 hour, 45 minute, 30 minute, not very higher time frame, but a relatively higher than 5 minute. We can have a look at essentially a further confluence if we're looking for shorts on the lower time frame. Is it overall bearish? And this is the further confluence to obviously provide yourself with that confirmation that this is likely to go in your direction and in your favor. And that will be everything for this video. If you do have any further questions, feel free to drop a comment below, and I'll be happy to answer it within the best of my abilities, essentially. And obviously do have a look at the Discord with the course as well, as I do cover this further with a lot more detail. This is just essentially an introduction to it and what I've been trading recently, as I have moved away from the higher time frame and I have just focused on the lower time frame. But I hope you all had enjoyed this video and able to pick up a few things from it, and look forward to posting an update video with further information in the future. Take care.